In a grim analysis issued on the eve of the G20 Leaders Summit, the International Labour Organization says the global economy is on the verge of a new and deeper jobs recession that will further delay the economic recovery and may ignite more social unrest in scores of countries. Raymond Torres, director of the ILO International Institute for Labour Studies, joins me now live from our Geneva bureau. Hello there. First of all, tell me about this social unrest index that you've launched. What does it show about the level of discontent and which countries are worst affected?
The level of discontent is growing in most countries. In 40% of countries worldwide, it is growing, but it is growing even more in advanced economies. Why is it so? The first reason is the job situation. People are unhappy about the job market. The second reason is that what they see is increasing inequalities. Vulnerable people have been hit and have been hit disproportionately by the crisis, but at the same time, the incomes of higher income people continue to grow or stay very high. So there is a perception that the crisis is being handled in a very unfair manner. So what happens is that in a number of countries there is unrest, actual unrest, which means people demonstrate, go out in the streets and speak widely and about the problems that they face in their daily lives. In other countries, you don't see discontent in the streets, but it is happening little by little in society, in every family. People are worried about the future.
You talk about those scenes of unrest. We've seen them in Greece, yet today, in the last few minutes, we've just heard that Greece is to hold a referendum on the deal done to try and save the euro. That deal means that Greece should have to implement lots of structural reforms that the people don't like, but those reforms are vital to growth and to the creation of jobs, aren't they?
What is needed is a vision. It is not possible to have single country approaches to the recovery. It is very important to have a global approach to the recovery. Greece cannot get out of the crisis on its own. It needs global growth. It needs countries that have the space for that to have increases in wages in line with productivity. For example, within the Eurozone, countries like Germany or the Netherlands do have the space for increases in wages in line with productivity, not faster, but no less than productivity, because that's what happened before the crisis. And these will help a lot countries like Greece, but also other countries in the Eurozone. So that's the first factor. Another thing also in Greece is that credit to small enterprises needs to restart. Even in Greece, you have people who want to invest, who want to create a business. They go to the bank and they don't get any money.
You say that growth is key, but also cutting the deficit is key as well, because otherwise they can't borrow the money to continue to run their countries. So there's a real balance there. Should they be cutting the deficit, or should they be spending more to promote growth? They can't do both.
Actually, there is a fine line which can be found. Just cutting the deficit without taking into account what you cut is actually counterproductive. Look at Greece. Last year they cut the deficit a lot, but actually growth also declined, and in the end the deficit continues to be very high. So what needs to be done is a fiscal consolidation process, taking into account the job imperative, the job. For that, you need to take into account employment-friendly programs. These should not be cut. Instead, the cuts should happen in other areas. And of course, if necessary, higher revenues should be found.
OK, Raymond Torres from the ILO in Geneva. Thank you very much for talking to us. The energy supply